Welcome back to the Profitable Mindset Podcast. I think everyone at some point has wondered about this investing versus trading. Which one is the real path to building wealth?
Well, it's not as simple as that. It's a much more nuanced question. I mean, the truth is both investing and trading can help you build wealth, but they each require very different approaches and different mindsets.
Okay, so let's break it down for everyone listening. Let's start with investing. What's the basic idea there?
So at its core, investing is, well, it's really about putting your money into something, an asset, with the expectation that it's going to grow in value over time.
Right, and we're not talking about quick flips or anything like that. Investing is more of a longer-term thing.
Yeah, definitely. Investors, they're looking at the long game. They want to see steady, consistent growth.
Right.
Over years or even decades, not just overnight wins.
And of course, you can't talk about investing without mentioning compounding. That's a word everyone throws around. How does that actually work in investing?
Compounding, it's kind of like the magic ingredient in investing. It's the snowball effect. You're earning returns not just on your initial investment, but also on the returns you've already earned. It keeps building on itself.
So basically, you're letting those investments just sit and grow over a long period. And that's how the compounding really kicks in.
Exactly. Just to give you an example, let's say you invest $10,000 and it earns a steady 8% return every year. Well, after 20 years, you could have over $46,000 without putting in any extra money.
Wow, time really is on your side when it comes to investing.
For sure. Now, on the other hand, you have trading,
which is all about taking advantage of those price swings that happen, right? Those short-term price swings.
That's it. Traders are looking for chances to buy when the price is low and sell when it's high, often within very short time frames.
So instead of waiting years for something to go up in value, they're constantly watching the market, trying to time everything perfectly.
Exactly. They need to be really quick, able to make decisions fast, and definitely comfortable with taking more risks because you're trading a lot more frequently and trying to predict those quick market movements.
It sounds like investing is running a marathon and trading is sprinting. Different skill sets for each.
Great analogy. And to really get why they're so different, I think it helps to look at how these ideas, how they evolved over time. We didn't just wake up one day with the stock market and these crazy trading algorithms.
Yeah, let's take a step back and see how we got here.
So, believe it or not, this all started thousands of years ago in ancient Mesopotamia. That's where silver was first used as currency.
So we're talking barter systems and the very first types of trade.
Exactly. Then you have civilizations like the Greeks and Romans coming along and introducing coins and early versions of banks. But one of the biggest changes happened in the 17th century with the Dutch East India Company. You might have heard of them, the VOC. They were the first to sell shares of their company to the public.
Wow, so people could actually buy a piece of the company. That's really revolutionary when you think about it. It was the beginning of the stock market as we know it.
Exactly, and it caught on quickly. Stock exchanges started popping up all over, first in London and then in New York. In fact, the New York Stock Exchange got its start in 1792.
And along with those exchanges came the traders.
Yeah, I mean, traders have always been around. They were always trying to make money from price differences, right? But those exchanges gave them a much better, more organized place to do their business.
It's amazing how much has changed from those early days. Now, anyone with an internet connection can be a trader, and technology has changed everything. High-frequency trading wouldn't even be possible without all the advances.
Absolutely. Globalization, technology, and the internet have all had a huge impact on how things work in finance. But even with all that, the main ideas behind investing and trading haven't changed.
So for our listeners, how can someone figure out if they're more of an investor or a trader? What should they be thinking about?
I think the most important factors are personality, what you're hoping to achieve, and how much risk you can tolerate. Those are the big ones.
Okay, so let's say you have someone who's a typical investor. What are some of their traits?
Investors, they're usually patient people who are good at thinking about the long term. They know that the market's going to go up and down, but they believe that overall it's going to keep growing over time.
They're not bothered by dips in the market.
Exactly. They keep their eyes on the big picture, steadily building wealth over years and decades.
And what about traders? How are they different?
Well, traders, they tend to be more quick on their feet, able to think fast, and they need to be okay with a bit more risk. They're always watching the markets, looking for those quick chances to make a profit.
So they're the ones who aren't afraid of potentially losing a lot, but also potentially winning big.
Right. They actually see those ups and downs as opportunities. They're constantly studying charts and using different tools to try and perfectly time the market.
So it's really about figuring out which approach fits your personality and what you feel comfortable with. Do you think some people might even do a bit of both?
Absolutely. It doesn't have to be one or the other. Some people have a core set of long-term investments and then also do a little trading on the side.
It all goes back to knowing yourself. Now, let's dive a little deeper into investing. We talked about compounding, but what makes it so powerful?
It's all about that exponential growth potential. For example, if you invest $5,000 each year, starting at, let's say, 25, and earn an average of 7% back annually, by the time you're 65, you could have over $1 million.
That's incredible. You definitely want to start early and keep putting money in consistently.
Yes. The earlier, the better. Those early contributions can really grow into something big.
But it's not just about randomly investing in things. Investors use something called fundamental analysis. Can you tell us a bit more about that?
Sure. So fundamental analysis is all about really digging into the details of a company, looking at their financials, their business model, who their competitors are, and their potential for growth. It helps investors determine the company's true value.
So they're looking for those hidden gems, the companies that maybe the market's undervaluing, but that have great potential in the long run.
Exactly. And once they find those, they invest for the long haul. They're not swayed by what the market is doing in the short term.
Okay, I think our listeners are starting to see what it means to think like an investor. Let's switch gears now and talk about trading. What can you tell us about that world?
Well, traders rely a lot on what's called technical analysis. Instead of looking at company financials, they're studying price charts, patterns, and past data to try and figure out where the price is headed next.
So they're trying to understand the language of the market, looking for clues in its behavior.
Exactly. They're looking for hints that might suggest where the price is going, and they have to be ready to act fast.
Now tell me about leverage. How does that work in trading?
Leverage is tricky. It can work for you, or it can work against you. It basically lets you amplify your gains by letting you borrow money to increase your position size. But the thing is, it can also make your losses much bigger.
So you need to know what you're doing and manage your risks carefully.
For sure. Let me give you an example. Let's say you think a stock priced at $100 is going to go up to $110, and you have $1,000 to invest. If you don't use leverage, you can buy 10 shares. If the price goes up like you predicted, you make a $100 profit. But if you use leverage, and let's say you get 10.1 leverage, you could actually control $10,000 worth of that stock. Now, if it goes up to $110, you make a $1,000 profit.
Oh, I see how leverage can really boost your profits. But like you said, the downside is that it can also make you lose a lot more.
Right. If that stock went down to $90 instead, you'd lose $1,000 with leverage and only $100 without it. Risk management is so important for traders.
It's a balancing act for sure, going for those big wins, but also protecting yourself from the big losses.
Exactly. That's where things like stop-loss orders and being careful about your position size really come in. We'll talk more about this later.
This has been really helpful in understanding the core differences between investing and trading. Our listeners can probably see how each one needs a different approach and mindset.
For sure. And it's not about which one is better. It's about picking the one that works best for your goals, your personality, and how much risk you're willing to take.
Okay, let's take a break here. When we come back, we'll explore the different types of markets and all the tools that investors and traders use to achieve their goals. Welcome back to the Profitable Mindset Podcast. So we've talked about the differences between investing and trading, but now I want to get into where all this actually happens. What are the markets and all the tools that people use?
Yeah, the financial markets. That's where the magic happens. There are so many different ways to get involved, so many instruments to use, and it can definitely feel a bit overwhelming at first.
Okay, so let's start with the most familiar one, the stock market. What exactly is the stock market?
Well, simply put, it's like a global marketplace where shares of public companies are bought and sold. When you buy a stock, you're buying a small piece of ownership in that company.
So you get to be a part owner and potentially benefit from the company's success.
Right. And you might even get paid dividends, which are like a portion of the company's profits shared with the shareholders.
Okay, so that's stocks. What are some other important players in this world of finance?
Another big one is bonds. Basically, bonds are loans that investors make to governments or companies.
So when you buy a bond, you're lending money and you expect to get paid back with interest.
Exactly. And bonds are usually seen as less risky than stocks. They tend to offer more predictable returns, which makes them a good choice for people who want stability.
Okay, stocks and bonds. Now, what about ETFs? I keep hearing that word.
ETFs, or exchange-traded funds. They're a really good way to get a diversified exposure to, say, a particular sector of the market or even the entire market itself.
Feel like baskets of stocks.
Yeah.
All packaged together.
Yeah, exactly. So, for example, let's say you want to invest in the S&P 500. That's an index that tracks 500 of the biggest U.S. companies. Well, you can just buy an ETF that follows that index. Then you instantly own a piece of all of those companies all at once.
That sounds so much easier than having to pick out individual stocks.
Right. It's very efficient. And ETFs usually have lower fees than actively managed mutual funds.
Speaking of mutual funds,
Yeah.
where do they fit into all of this?
Mutual funds are kind of similar to ETFs in the sense that they pool money from a bunch of investors, and they use that money to buy a diverse portfolio of assets.
But with a mutual fund, you have a professional fund manager who's calling the shots, right?
Yeah. They do all the research, all the buying and selling. They manage the whole thing.
So we've talked about stocks, bonds, ETFs, and mutual funds. What about the more, complicated instruments, the ones that seem a little bit more intimidating?
You're talking about derivatives.
Derivatives. It sounds like something out of a Wall Street thriller movie.
The name might sound scary, but they're not that complicated. Derivatives are basically financial instruments that get their value from, or derive their value from, another asset. So instead of owning the asset itself, you're kind of betting on whether its price is going to go up or down.
Okay, give me an example, a real-world example.
So let's talk about options. An option gives you the right to buy or sell something at a certain price within a certain time frame, but you don't have to do it.
So it's like you have a reservation at a fancy restaurant. You can go and eat if you want, but you don't have to.
Exactly. It gives you some flexibility. Now, another common derivative is a futures contract.
I've heard of those, but I don't really know how they work.
Well, with a futures contract, you are obligated to buy or sell something at a predetermined price on a specific date in the future. You're basically locking in the price today for a transaction that'll happen later.
So like, if I think the price of gold's going to go up, I could buy a futures contract to buy gold at a certain price 6 months from now.
Mm-hmm.
If gold does go up like I thought, I make a profit.
Yeah, that's the idea. Businesses actually use these a lot to protect themselves against price changes. Like, let's say you're a farmer and you want to be sure about the price you'll get for your crops in the future. You could sell a futures contract to guarantee a price no matter what happens to the market.
Got it. Okay, so we've got all these different financial instruments, but where do they actually get traded?
That's where market structures come in. There are a few main types. We have centralized exchanges. These are like the NYSE or NASDAQ.
So those were like physical places, like a marketplace. But instead of buying and selling vegetables, you're trading stocks.
Exactly. Those exchanges bring buyers and sellers together in a regulated environment. Everything has to be fair and transparent.
And then you have the over-the-counter markets, the OTC markets.
Right. Those are more decentralized. There's no central exchange. The transactions happen directly between two parties.
And of course, the foreign exchange market, the Forex market.
Forex. That's the giant global marketplace for trading currencies. It's where you have all those currency pairs like Euro US dollar or British pound Japanese yen.
That's where all the action is for people who want to make money from the changes in currency values.
Exactly. The Forex market is huge. It's the biggest and most liquid financial market in the whole world. And it's open 24 hours a day, 5 days a week.
Wow, that's a lot to take in. It seems like there's a market and an instrument for literally anyone, whether you're an investor or a trader.
Yeah, and that's actually a good thing. But the important thing is to know what you want to achieve, how much risk you're comfortable with, and how involved you want to be.
Okay, now let's talk about the tax implications of all this.
Taxes. Can't forget about those. Different investment and trading strategies are treated differently when it comes to taxes. So that's something you have to keep in mind.
Right. I know here in the U.S., if you sell something you've held for less than a year, those are short-term capital gains.
Yeah.
And they're taxed at a higher rate than long-term capital gains.
Exactly. So if you're a trader who buys and sells all the time, you're probably going to pay more in taxes than someone who's holding their investments for a long time.
And of course, there are also tax-advantaged accounts like 401ks and IRAs that are meant for saving for retirement.
Absolutely. With those accounts, your investments can grow without being taxed right away. You only pay taxes when you withdraw the money, and usually that's when you're retired and in a lower tax bracket.
It seems like, it's not just about choosing the right investments. You have to be smart about taxes too and make sure you're being as tax efficient as possible.
Totally. And that actually brings us back to something we've touched on before, but it's worth emphasizing again and again: risk management.
Yes. Risk management. You can't talk about investing and trading without talking about risk.
Right. And it's not just a one-time thing. It's something you have to think about all the time.
So what are some of the most important risk management ideas that everyone should keep in mind?
Well, the most fundamental one is diversification.
Don't put all your eggs in one basket.
Exactly. By spreading your investments out, different types of assets, different industries, even different countries, you're lowering your risk.
So if one of your investments does poorly, the others can help balance things out.
That's the idea. You also need to figure out how much risk you're personally comfortable with. How much volatility can you handle without freaking out? How much are you actually willing to lose on a single trade?
You have to know yourself and what you can handle emotionally.
Absolutely. Be honest with yourself. Otherwise, you might make rash decisions, and that can really hurt your chances of success in the long run.
That makes a lot of sense. It's not just about the numbers. It's also about how you're going to feel if things don't go your way.
Exactly. And we've talked about stop-loss orders. I think it's worth mentioning them again because they're so important, especially for managing risk.
So a stop-loss order is basically like a safety net for traders.
That's right. You set a price level, and if your investment drops to that price, it's automatically sold. It helps limit how much you can potentially lose, and it keeps those losses from getting out of control.
And there's also something called position sizing. That's especially relevant for traders, right?
Yeah, position sizing is about figuring out how much of your money you put into each trade. You don't want to risk your whole account on one single trade.
So even if that trade goes the wrong way, you're not totally wiped out.
Exactly. You got to strike a balance. You want to maximize your potential wins, but also minimize your potential losses.
And for people who are more into investing, risk management also involves rebalancing your portfolio.
Yeah. Rebalancing is about adjusting how much you have in each asset class. You want to make sure that your portfolio still reflects your risk tolerance, even as the market changes.
Like, let's say you start out with a portfolio that's 60% stocks and 40% bonds, and the stock market does really well. Now, your stocks might be 70% of your portfolio.
Right. Then you want to sell some of your stocks and buy more bonds. Just to get things back to that 60-40 split, that way you don't become too exposed to any one asset class.
So basically, risk management is an ongoing thing. You have to keep checking in and making adjustments as needed.
Absolutely. And it's key to succeeding, whether you're investing or trading.
This has been really helpful breaking down all the different markets, tools, and risk management ideas. And of course, the financial world doesn't stand still, right? It's constantly changing.
Definitely. New technology pops up all the time. So in our next segment, we're going to explore some of those exciting innovations that are shaping the future of investing and trading.
Welcome back to the Profitable Mindset Podcast. We've talked about the history, the differences between investing and trading, all the markets and tools.
Right.
It's a lot.
Yeah, we've covered a lot of ground, but now comes the really important part, figuring out how you're going to approach all of this. You need a plan, a roadmap for your own financial journey.
Okay, that makes sense. But how do you even start with something like that? It feels kind of overwhelming.
Well, the first thing, the most important thing, is to figure out what you want to achieve. What are your goals? Are you saving for retirement? Do you want to buy a house? Maybe you're trying to pay for your kids' education? Or maybe you just want to grow your wealth. Whatever it is, you need to define it.
Right. And it's not just about the what, but also the when. Are these goals you want to reach in the next few years? Or are you thinking more long-term, like decades from now?
Exactly. How much time you have makes a big difference in what you choose to invest in. A longer-term goal means you can ride out those market ups and downs and maybe take on a little more risk. But if your goal is short-term, you might need to be more conservative.
Okay. Goals and time horizon. Check. What's next?
Next is figuring out your risk tolerance. This is about, well, it's about how much risk you're comfortable with. How much could you potentially lose without panicking? Could you handle a 20% drop in your investments? Or would even a 5% drop keep you up at night?
So it's not just about how much money you're willing to lose, but also like how you'd actually feel if you lost it.
Exactly. It's about being really honest with yourself. Because if you pick a strategy that doesn't match your personality, you're more likely to make impulsive decisions. And that could really hurt you in the long run.
Okay, so you've got your goals, you know how much time you have, and you understand your risk tolerance.
Yeah.
Then what?
Now you need to think about your strategy. What's your investing style? Are you the type who likes to be hands-on, or do you prefer a more laid-back approach?
A lot of people are probably somewhere in between, right?
You're right. It's a spectrum. Some people love researching stocks and picking them out themselves, but others would rather keep things simple and invest in things like broad market ETFs or mutual funds. And some people even do a combination of both.
So it's really personal. What's comfortable for you and fits your life?
Absolutely. You also need to consider how much time you have to dedicate to this. Are you willing to spend, hours every week researching companies and analyzing charts? Or are you more of a set it and forget it kind of person?
Right. Because some strategies need a lot more attention than others.
For sure. If you don't have a lot of time, index funds and ETFs are a good option. They don't need constant monitoring, and they give you exposure to a wide range of stocks.
And if you do enjoy getting more involved,
then you might enjoy researching specific sectors or even exploring more niche investment opportunities, picking individual stocks, that kind of thing.
the main thing is to choose something that you understand and that fits into your life.
Yeah. Okay, so you have your goals, your risk tolerance, your investment style. Now what?
Now it's time to set some rules.
Yeah. Think of them as guiding principles. They'll help you make better decisions, even when you're feeling stressed or emotional.
So like boundaries to keep us from making those rash decisions.
Yeah. Exactly. It's all about having a system. That way you can stay disciplined, even when the market's being crazy.
So what are some examples of like what these rules could be?
Okay, well, one rule could be about when to buy or sell. You can decide this based on certain metrics, like valuation metrics or technical indicators, or maybe even changes in your own financial situation.
Right. It helps to have those criteria figured out ahead of time. So you're not just guessing or acting on your emotions.
Exactly. Another big one is position sizing. That's all about how much you're going to invest in each specific asset.
So like deciding what percentage of your portfolio you're going to put into each stock or bond.
Yeah, it helps manage your risk because then no single investment can completely derail your whole portfolio.
Okay, so we've talked about entry and exit strategies and position sizing. What else should we be thinking about?
You also need a rule about knowing when to cut your losses. It's tempting to just hold on to a losing investment hoping it'll come back up.
Oh yeah, I think we've all been there, convincing ourselves that a stock is going to rebound any day now.
It's an easy trap to fall into. But setting a stop-loss level ahead of time helps you to be more objective.
So it's like a safety net that protects you from losing too much.
Exactly. And that's key to managing your risk effectively. And, we've talked about risk management a lot in this episode, but it's not just about having a plan. It's also about having the right mindset.
Right, because it can be hard to stick to your plan when the market is going crazy.
That's why you need to know your own risk tolerance
Yeah.
and have a set of rules. It's like having an anchor that keeps you grounded during the storms.
It's about keeping your eye on the long term, not getting caught up in the day-to-day ups and downs.
Exactly. And remember, your plan isn't set in stone. You should review it every so often and make changes if you need to. Your goals might change. Your risk tolerance might change. Your strategy might need to change. Life is always changing.
That's a good reminder. And the markets change all the time too, so you've got to stay informed and be willing to adapt.
Exactly. Being adaptable is so important. Okay, so we've covered a lot about building a personal trading and investing plan. What are the key things you want our listeners to remember?
Yeah, what are the big takeaways?
The most important thing is that there's no right answer for everyone. What works for one person won't necessarily work for someone else. So take some time to figure out what you want, what you're comfortable with, and what fits your life. Experiment. See what works best for you.
Like finding the right pair of shoes. What fits one person might not fit another.
Exactly. And don't be afraid to ask for help. Financial advisors can give you personalized advice. They can help you make a plan and navigate all the ins and outs of the markets.
That's great advice, especially for people who are just getting started.
And finally, remember, this is a journey. Investing and trading are a journey, not a destination. You're always learning and growing and adapting.
Be patient, be disciplined, and keep learning. This has been so helpful. I think our listeners are going to get a lot out of this. Thank you so much for joining us on the Profitable Mindset Podcast.
It was my pleasure. And remember, the journey to financial success starts with that first step. And we're here to help you along the way.
Until next time, stay profitable.